We're obviously talking about structural reform here, and we've talked about Carmen Reinhart and the book they wrote. This time it's different. The question as I was reading that book that popped into my brain: past history, nation states have gotten to high levels of debt, by and large, got themselves out by inflating their currency and devalued the debt. Our debt, though, is structural in terms of entitlements, our liabilities that are tied to inflation. And I just kind of want to, from my standpoint, I'm going, we can't really inflate our way out of this debt. That's the question I'm asking. I just kind of like your comments on are we in a bigger pickle than past nations that could inflate their way out of the debt? Dr. Johnson, you're shaking your head, so I'll go to you first.
No, I think I was nodding my head actually, but we're certainly in a big pickle. There's no question about that. And I like your point that you can't inflate your way out of some of the liabilities. You can try and inflate your way out of some of the debt obligations, but also remember our debt maturity is pretty short. Average maturity is about 4 years. The UK is about 14 years. The UK has much more incentive to inflate in the classic Reinhardt way than we do. And ultimately, we need to look at the liabilities and the revenues that we're willing to raise to back those. And clearly, there's an imbalance. We have a huge advantage, potentially, relative to other countries in the Reinhardt and Rogoff book, which is we are the reserve currency. We are able to borrow internationally. We have a credit line unsurpassed by anything any country's ever had. And we earned that credit line. However, we are in the process of wasting that credit line. We are not investing in productive assets. We are not upgrading our education system. We are not boosting growth in other ways you might prefer to boost it. We're just spending that, borrowing to finance consumption in excess of our income. And that will absolutely end badly. So the pickle we are in could well end up being a very large one, and maybe bigger than what other countries have had. We have an opportunity to fix it, an opportunity that the Europeans don't have right now. The Europeans are in a different place from us, and a much, much tougher place, and we should take that as a cautionary tale and use that to fix our own budget today. Mm-hmm. So I think we're all on the same page with regard to your general point, Senator.
You touched on my next point I wanted to ask was about the reserve currency. I know some countries are talking about maybe a basket of currencies. I mean, how long do we have? I mean, I realize you really can't answer that, but I mean, is there really a concerted effort to move away from the U.S. dollar?
I wrote a book on that a long time ago, try to keep close to it. It's critical to remember that the reserve currency role is a two-edged sword. It buys us more time, as colleagues have said, but that also means we tend not to have the pressure that we need to adjust. So even in sort of fundamental terms, is it a good thing in the national interest? It's ambiguous. But once the worm does turn, if it inevitably does, as we all think, then the reserve currency role can be a huge, huge sword of Damocles. There are about $25 trillion of foreign-held dollars floating around the world economy. That's the sum of the accumulation over the years that let us run the deficits that we're talking about. But we used to call that a dollar overhang, which implies, correctly, that it could come cascading down. And so if the worm turned and the markets began to look askance at what we're doing, then the great reserve currency role of the dollar provides additional huge ammunition to intensify the pressure on us as people around the world sell those dollars that they've accumulated over the past decades. Now, whether that happens depends on two things. A, is there an alternative to the dollar? In underlying structural terms, the euro certainly is one. It's a bigger economy. It's got deep financial markets. It meets all the criteria. Right now, it's not an attractive alternative. But if they do get their house together, get their act together, get their house in order, 2 or 3 years out, they certainly could be. And comes China, which is going to be the biggest economy, is going to have by far the world's largest trade and foreign investment flows. Once they decide to move off capital controls and make their currency convertible, that's another alternative. So we're headed toward at least a three-part global monetary system. We call it a multiple currency system, dollar and euro and RMB over different time periods. But if we're thinking even 5 years, certainly the euro's in the picture. If we think 10, the RMB probably is in it too. And so the non-alternative that Adam rightly pointed to now does become very different. So even in an annual flow sense, people are not going to be compelled to put their money in dollars. And to the extent the reserve currency role is an asset, as it certainly is in the short run, that too will be fading. And then, as I say, if the worm turns, it can become a huge liability. So I would never rely very much on that one to deal with the sustainability of our situation over any reasonable period of time.
Senator, I think I spent 5 years in Argentina on their debt restructuring. Every Argentine school child knows, because the ones that don't know this have been killed off by Darwinian survival. Right? Every Argentine school child knows there are only 3 solutions to an over-indebted economy. You write down the debt, you raise the surplus to pay the debt, or you inflate the debt away. Right? There are no other solutions. We've learned that after 200 years. The question of the reserve currency, you asked the question of should there be a basket as an alternative?
I'm saying,
could there
talking about it? Yeah,
I'm talking about it.
Yeah.
Every person in the world can create their own reserve basket. If you think that you like a basket of reserves that's 20% yen and 10%, 50 and 40% euros and 30% dollars and throw in some the Brazilian real, you can create that yourself. Central banks do that all the time. The idea of creating a, quote, official reserve currency basket, such as the SDR, the special drawing right at the IMF, was supposed to be, that's a very inefficient outcome, because that's saying we've decided what the optimal basket is. We've set the weights, the percentage of each currency. Well, I may like those weights. Fred may think, I don't like those weights. I want a different basket. And Simon may say, I want a third basket. The markets can create their own basket. There's no purpose in creating a basket currency today. Finally, as Fred pointed out, the reserve currency can change very quickly. What has held us up and what has taken the pressure off the U.S. government to actually make the decisions it should have made years ago is because there's been no viable alternative. The euro was a viable alternative. It now isn't for the moment, but as Fred said, if they, over the next 3 years, as I believe they do, actually put in place a stable system, then it will be, and you will see massive flows. And the only thing that will surprise you more than the size of the flows as they move out of the dollars into the euro will be the speed with which it will take place.
Okay, just beg indulgence for one more question. Absolutely. This is about taxes and the effect on growth. During my lifetime, the highest marginal tax rate's been 90%, 70%, 50, 28, 31, 35, 39.6, 35. For the last 50 years, prior to 2008, the average amount of revenue generated or extracted from the economy has been 18.1%. And the variation's been really pretty tight around that mean. It goes up too much, you end up with a recession, not necessarily, I'm not sure what the cause is, but just looking at the data, very tight around that 18.1%. I'm not sure what causes that. I realize tax policy drives it, and when you have high marginal rates, you have all kinds of deductions. But I have a suspicion as well that just like with capital gains taxes, is when you raise them higher, people expose less of their income to that capital gains tax. So I am highly concerned if we raise taxes, we're going to harm economic growth, and I really do sincerely believe that the #1 component of a solution is economic growth. So if you could just sort of speak to the effect of marginal tax rates, the ability of the United States government really to extract much more than that 50-year average over any kind of long period of time, and really speak to increasing tax rates basically to try and drive more revenue. I know that's kind of a big subject, but in 30 seconds or less.
That's a huge and terrific subject, Senator. And again, I take this on in this new book that's coming. I think you and I may disagree on how to read the evidence and on the ability at the federal level to raise revenue. I take your point, though. You're absolutely right that there has been a stability around federal revenues for a long time prior to the crisis, and we should reflect on that. Of course, there isn't stability to our future medical costs. And that's the big collision if you look over a 20 or 30-year time profile. If you're really going to cap federal revenue at 18 or 19%, that has major consequences for what you are able to pay in terms of the healthcare costs of elderly Americans. And I think we should have that conversation. I would go on the side of covering more of those healthcare costs, personally, I mean, we should also control those costs, obviously, but those are tough to control, and demographic change and technological changes mean those costs are going to increase. And the CBO, by the way, relative to the European Commission, CBO is very honest about what those future costs are going to be. The Europeans, not so much. So at least that's on the table. But I would go a little bit more towards allowing revenue to increase, and I think there's ways to do that over the medium term. Take Senator Conrad's points about dangers of precipitate austerity, but I think over the medium term we can do that without damaging growth. I think that we can actually do that in a way that is pro-growth and also quite reasonable. But I don't expect that you and I will agree on that in the end, Senator. I think that's fine. I think now's a good year to have that discussion and to get these issues out in the open and to show people what's the menu. In our book, we lay out a menu of options, and we give you a House recommendation from the menu, but you can also pick whatever you want off the menu, as long as you get onto what I think all of us today have agreed on is a path to fiscal sustainability and a debt to GDP level that's under control.
Yeah,
you want to agree with me?
Just partly. Two one-sentence responses. One, I think it is more important to get the overall budget into sustainable balance than it is to avoid an increase in government revenues as a share of the economy. Point two, I think we can get a contribution to that outcome with higher government revenues without raising marginal tax rates, which you stressed, getting rid of a lot of tax expenditures and finding a lot of base broadening to go along with maintaining or even possibly cutting, like in the corporate case, some of the tax rates. So I think there's a perfectly doable package here that addresses at least what seems to be your main concern, marginal rates, at the same time increasing revenues as part of an overall budget package, which to me is the most important priority.
Senator, I think your concern about tax rates is very well focused. I think two things. One, we're going to have to pay for what we've wasted over the last 30 years. Your chart showed our debt's gone up, our deficit's gone up. Someone has to pay for that. Right? It was a mistake. We all agree we shouldn't have done it, but we have to now pay for it. Right? That is going to require a rise in tax revenue, not in tax rates. Fred's absolutely right. And the fact of the matter is, if you raise marginal tax rates, especially on high-income people, you're not going to generate the revenue. First, there's a question of how much more revenue you will generate, and you will certainly not generate anywhere near the amount of revenue you need to close the gaps significantly. So you have to think of how do you broaden the tax base, and how do you broaden the tax base without affecting economic growth or with minimal impact on economic growth. And that is the key issue. Raising marginal tax rates can be politically attractive. It can be politically popular. I mean, we have, in this country, 50% of U.S. voters don't pay any federal income tax. 60% receive more from the government than they pay in income taxes. So raising taxes on the remaining 20 or 30, the highest 20 or 30% can be politically expeditious. But I think you have to any meaningful reduction in the deficit is going to require a broadening of the tax base. Raising tax rates will not help it.
Even though people don't pay what's called federal income tax, they pay payroll taxes. And it's a historical accident, actually, that we make this distinction between payroll taxes and income taxes. Most other countries don't make that distinction. You're funding Social Security, you're funding Medicare out of the payroll taxes. That is an important federal tax obligation that most voters actually do pay.
I would raise one quick point on that. I view Medicare and payroll taxes, those are pension funds and healthcare costs. Those are not taxes to pay for general government expenditure.
I agree.
Let me just make this point.